Hey guys, my name is Nicolette Mashile and welcome to the Financial Bunny TV. Today I'm going to be talking about something which is a disruptor in the market and it is called solvency, right? Now they've got an account called the Insurance Savings Account. But before I get into all of that, I want to tell you guys a little bit of a story, obviously. So a couple of years ago when I was still driving Kidiboni, this one time, I remember driving on Jan Smuts. If you are from Joburg or you're familiar with Joburg and you know the big Jan Smuts road, and there's a robot there that is in front of Dunkeld or that Dunkeld shopping center, and then there's a road that comes from the right which is called Bombas, right? I remember driving on Jan Smuts and I'm going, it's like drizzling, right? At around about, I think it was around about 1 a.m. in the morning. So I'm driving on Jan Smuts and I am going straight. And here's this guy in his 1400, okay? And he's coming from Bombas. So obviously there's a turning lane that turns right into Jan Smuts so we can both go straight. So what happens is the robot goes orange. So I think, okay, but it's going green into orange or amber, whatever the color is. And I'm now about to pass as across the robot, right? This guy fails to slow down, comes swinging his car, and instead of turning into the more further right lane, he literally turns into my lane. So he's pushing me off the road. So I then now get off the road with Kidiboni. And of course, I hit the pavement, the wheel goes off, and I actually bend the control arm of the car. So no problem, I go to insurance and I claim from insurance, and insurance says to me, we can only pay so much money for you. I think the payment of everything was around about 70-something thousand rand. And they said to me, you've got an option of either writing the car off, or we can actually pay half of it because, to be quite honest, you have not, I can't even actually remember what are some of the reasons. And luckily I also had a car hire feature or added value service or a service. I was paying for it definitely on the insurance. So luckily they gave me another Polo. I was driving that at the time, but my car took more than a month to fix and the car hire was only for a month. So I ended up actually starting to take taxis. And I remember I was working in Glen Hazel, so I was driving from Randburg all the way to Glen Hazel. So you gotta take a taxi from Randburg, you gotta take a taxi from where you're staying to Randburg Taxi Rank. From Randburg Taxi Rank, you take a taxi to Alex, and then from Alex, it drops you off on a road where the school was. And it was just so much hell for me because I thought, okay, I'm paying insurance, and all of a sudden now I've got to pay additional amounts of money over and above the excess that I need to pay. And I was just so, I was upset because I got this car in 2012. So we started paying insurance in 2012. So 2012, 2013, 2014, I am basically paying my premiums. I'm not claiming. And the first time that I need to claim, I'm being told that I need to add on money over and above my actual premiums. And I was very upset about it. And that kind of segues into the conversation about why is insurance such a painful thing to pay? And it's purely because people's experiences with insurance is that once they've been paying for their premiums, they struggle to get insurance companies to actually pay them back or when they put in claims. But that's not what we're here to talk about. What we're here to talk about is how many times do you think that the ordinary driver in South Africa will claim from their insurance? And will they ever actually claim the same amount of money that they've paid in premiums? Now, of course, I know that insurance is not a guaranteed, it's a wager, but it should be available to you when you actually need it. But what happens if you don't need it for 5 years, but you keep paying and you keep paying and you keep paying? What actually happens to your money? Now, I know for a fact that insurance companies do take our premiums and they actually invest them in investments where they actually make more money. So they actually take my money and they make me more money. And then sometimes on the day when I need them to help me, they don't have money or they don't want to pay out my claim. That is annoying. Which is why when I was told about solvency, I got really excited. So as I was saying, solvency is an insurer for short-term insurance. Now remember, there's a difference between short-term insurance and long-term insurance. Long-term insurance, you are insuring the body, the life. Short-term insurance, on the other hand, you are insuring the asset, the things that you acquire. Things like cars, things like laptops, things like household items inside your house. So that's what solvency does. But they take it another notch. They say, we will insure whatever it is that you want us to insure. And over and above ensuring that, a part of your claim, we will save into a money market account for you. So that the day you need to claim, if there is an excess that you need to pay, you can withdraw from your savings and you can pay for your excess. And let's say in a 12-month period, you do not have any claims to do. You can get half of your money back. So the premiums you've been paying, you can get half of it back. It can be given to you. So technically, if you are somebody that feels like, oh my goodness, insurance is such a grudge pay, maybe this is a turning point for you, because for the first time in South Africa, you can actually get your money back. Now, I'm not talking about those money back for no claims. It's not an incentive that you didn't claim. So even if you did claim, but you still have money in your savings account, at the end of the year, before the contract gets renewed or before the policy gets renewed, you actually have the right to be able to withdraw half of that. And what you use it for is up to you. It's between you and your God. How fantastic is that? I think that's really cool because one, for me, it fights two things. It makes me and my car, or not my car, well, my car is also short-term insurance. So my car, my items, my goods, my equipment, they're safe because I am actually paying insurance for them. But while I'm paying for insurance, I'm actually also kind of like saving without even noticing that I'm actually saving money. So I can actually save money for December using my insurance policy. Now, I think that's pretty cool. So if you're looking for something like this and you think it might be able to assist you, please check out www.solvency.co.za. But don't let me tell you the story. Let the actual CEO and founder of Solvency SA to be able to tell you a little bit about Solvency.
Solvency is a challenger brand in InsurTech, which combines insurance and savings. And what that does as a consumer is that your premiums get split between what normally goes to the insurer and what goes into your insurance savings account. You determine what goes into your insurance savings account based on the excess that you are willing and able to pay. So the higher the excess, the more goes into your insurance savings account. The insurance savings account is your money. It earns interest. You can use it to pay for your excess or withdraw it straight into your bank account every 12 months. What I'm saying is that up to 45% of the premiums that you're paying can go into an insurance savings account. And what we're saying is that not only that, but the money that goes there then can also earn interest. When you have an accident, you can then use the money in your insurance savings account to pay for your excess. If you don't claim, or whether you claim or you don't claim, in 12 months' time at renewal, you can withdraw half of whatever you've put in over the last year. Or you can keep the money there to grow and continue earning interest. So you are saving by just insuring yourself.